The definition of a Ponzi scheme is a form of fraud in which belief in the success of a non-existent enterprise is fostered by the payment of quick returns to the first investors from money invested by later investors. In other words, a fake business where there's no real business activity happening, and the person running this business collects new money from new investors, promising an unrealistic or unusually high return, uses the money from those new investors in order to pay the return to the original investors. MicroStrategy is a Bitcoin treasury company, one that famously raises money by issuing debt, and more recently has started issuing new preferred shares of stock that pay dividends higher than the typical stock pays in dividends, ranging from 8 to 10%. And here's the key, pays those dividends and the interest payments on its debt from the money that it raises by issuing those preferred shares and the debt. This has caused many people to make the association and say it's clear as day Michael Saylor and his company Strategy are running a Ponzi scheme. But there are a few key differences between a real fraudulent Ponzi scheme and what Strategy is doing here. First of all, the company MicroStrategy itself is a software company. In other words, there is a real business. It makes up a very small part of their overall earnings these days, but there is a legitimate business here. Number two, they are taking the money they are raising from investors and buying Bitcoin with the vast majority of it. A real Ponzi scheme is only using money it raises from investors, holding on to it and using it to pay off old investors just long enough to keep the grift going. MicroStrategy is taking as much of the money it raises as it can to purchase Bitcoin. And as long as Bitcoin keeps doing what it has always done and goes up over time, then it shouldn't be a problem. And the third difference here is that this is being done with preferred shares. I'm going to explain more in detail how these work, but the dividend payments of 8% or 10% on these preferred shares can be shut off at any time, which means investors are not being fraudulently manipulated into investing in something that they think is a guaranteed rate of return. They know, or at least they should know, that the dividends on preferreds can be shut off at any time if the company cannot pay it. So for these three reasons, number one, MicroStrategy has a real business, even though it's small. Number two, it's actually taking the money it raises from investors and doing something with it, in this case, buying Bitcoin. And number three, the returns or the income promised to investors can be canceled at any time. It means that it does not qualify as a Ponzi scheme, even though the income paid out in the dividends on these preferreds is only being paid by raising more money from new investors. Still doesn't count. However, that doesn't necessarily mean that this is a good idea for you to invest in these preferreds. So I'm going to explain to you exactly how these things work so you can make up your own mind. In order to understand how preferred shares work and what the risks and benefits are, first we have to start off with debt. If any company, or let's say any individual for that matter, wants to raise money in order to invest in something to grow their business, usually the easiest way to do that is with debt. You go to the bank, or companies will go to public markets and they will borrow as much money as they can at the interest rate that people are willing to provide. When public companies do this, it's called issuing bonds. And then those debt instruments can be traded and can be bought and sold. And whoever owns that debt gets paid the debt back by the company, plus interest. MicroStrategy has historically issued a lot of debt. And of course, they've used basically all of it to buy as much Bitcoin as possible. Currently, the total market cap of MicroStrategy is a little under $100 billion, which is still larger than the total value of all the Bitcoin they hold. And the reason why the market is giving MicroStrategy a larger market cap than its total Bitcoin that it holds is because of the expectation that the company will continue to buy more Bitcoin in the future. Markets are future discounting machines. And so investors in MicroStrategy believe that the shares, even though they're more expensive than the value of the Bitcoin right now, are worth it in the long run for the amount of Bitcoin that those shares will represent in the future. And the primary way that MicroStrategy is raising money in order to buy more Bitcoin is by issuing more debt. Now that brings us to the second thing that we need to understand before talking about preferreds, which is common stock. This chart that we've been looking at for MicroStrategy is a chart of their common shares. This represents outright ownership in the company itself, which means you have a full unlimited upside to all the future profits, and you have full unlimited downside to all the future risks. You are literally a part owner of that company, and your percentage ownership is the number of shares that you have in that company divided by the total number of shares. Now, companies can issue what are called preferred shares, which are like a blend of debt or bonds and common stock shares. MicroStrategy has issued quite a few of these. They have STRD, what they call Stride, that pays a 10% dividend, STRK, which they call Strike, that pays an 8% dividend, STRC, they call Stretch, pays a 10% dividend, and STRF, I think they call it Strife, and that pays a 10% dividend. Now, you'll see on each of these, there's an effective yield right now that is different than the stated dividend. Sometimes the effective yield is higher. In the case of STRD, the effective yield right now is 12.7% versus the stated dividend of 10, and STRF that has an effective yield of 9% versus the stated dividend of 10. Now, the reason for this is because the share price moving up and down for preferreds influences what the dividend will be for new shareholders. You can see STRF right now is trading at around $111 per share, while STRD is trading around $78 per share. So at the same number of dollars being paid out as a dividend on each share, if you buy those shares at a lower price, your personal income that you receive on it will be a higher percentage of the money you invested. Now, returns like this can seem wildly attractive to new investors. And so we have to talk about what happens in a worst case scenario. In other words, what if the company is forced to liquidate everything and return its money to its investors and its lenders? Where do preferreds sit in that mix? Well, in the case of any company going bankrupt, shutting its doors, the first people in line to get their money back are always lenders. Lenders always have the first right to get paid back. And so let's say something crazy happens, Bitcoin crashes to zero, MicroStrategy is forced to shut down and return money to everybody. The first people who will get their money back is the lenders. The bondholders will get their money back. If there is anything left over, then the next people in line are actually the preferred shareholders. That's why they're called preferreds. And then if there is anything left over after that, then it goes to the common stock shareholders. Now, as you can see, we have moved from least risky bondholders to the middle preferreds to most risky common shareholders, because in the event of the company shutting down, those common shareholders are the last people in line to get anything back, which means if there's not enough left over for everybody, then they're the ones who walk away with nothing. This makes sense because as an owner, first you have to pay back who you borrowed from. And as a shareholder, a common shareholder, you are an owner. So you're the last one to walk away with anything. It also means that the total potential return for all three of these groups is different. When you are a bondholder, the maximum you can get back is the principal plus the interest. There is no upside. So you have the lowest downside and also the lowest upside. If you are a common shareholder, you are a part owner. So if the company does extremely well in the future and the value of the company 10x's or 100x's, you're an owner. You get to participate in 100% of that upside. Preferred shareholders sit in between. They have more upside potential than the bondholders do, but they don't have near as much upside potential as the common shareholders do. Part of the reason for this is because many times those preferred shares are callable, meaning the company at any time in the future, if they want, they can buy back those shares at a specific predetermined price, which means if the company starts to do extremely well in the future and the share price of those preferred shares starts to go up too much, it might not mean you get to keep it because the company might be able to buy those shares back from you at a lower price than what they're going for on the market, which usually caps the share price of those preferreds. That callability also makes the effective yield stay within an attractive range because the share price of the preferreds usually won't just go up in lockstep with the company itself. Now, normally, if a company pays interest on its debt and pays dividends on its preferreds, or even if it just pays dividends on its common shares. The normal way to do that is from business profits. In other words, the company has an underlying business where they are selling a product, and after all of their expenses for people and real estate and advertising, they are left over with more money than it costs them to run the business. So they have a profit and they distribute some of that profit to their shareholders. The owners want to take advantage of the company being profitable and get paid a return on their investment. That is how normal dividends work. But today, in the over-financialized world that we live in, There are many things called dividends that I don't like to look at as dividends personally. For instance, there are ETFs like XYLD, and I'm not picking on XYLD here, there are literally hundreds of these things that pay a very attractive dividend rate. This one in particular right now pays almost 10%. But you have to ask, how is the income for this dividend being produced? And for XYLD, this is the long-term chart, that income is being produced by selling away the upside to the shares that it holds. That is what the covered call strategy does. You are allowing somebody else to pay you for the right to take the upside of the shares you own, which means the total return of these funds over the long term is abysmal. Even when you look at the total return chart, which includes all the dividends these funds have paid, this one specifically since inception has a total return of only 146%, while the S&P 500 by itself has returned over 400%. And so unless the income is being produced from an underlying business being profitable and returning some of those profits to its shareholders, I don't like looking at it as a dividend, as income. It's being produced in another way, which means there's risk involved. Sometimes that risk is the risk of losing out on the real upside potential of your holdings. But sometimes, in the case of MicroStrategy, that risk is just that the income evaporates one day. And that's because we know what MicroStrategy does with its business. The only thing it does, the vast majority of what it does, is it raises money by issuing new debt or issuing new shares of its common stock or issuing shares of a new preferred, like Strike or Stride or Stretch. And it takes that new money that it's raised from investors or lenders, and it uses the vast majority of that to buy Bitcoin. And then it takes some of it and uses it to pay the dividends on those preferred shares and pay the debt cost, the interest expense, the debt service payments. This is why people feel like it is very Ponzi-like, because the only way it is paying out dividends and payments is by raising new money. And a lot of that new money that it's raising from things like its preferreds, it's telling them, hey, we plan on paying you a dividend, which in this case, personally, I wouldn't consider this a dividend because it is not income being produced by an underlying profit from the business. This is income that is just being taken from a percentage or a portion of new investor cash. Now, it is true that they take the vast majority of the money they raise and they put it into Bitcoin. And Bitcoin historically has done one thing, and that is go up. And if that continues to happen, MicroStrategy will be fine. But if that doesn't continue to happen, if Bitcoin enters a bear market or it stagnates for a long time, and therefore MicroStrategy has an issue with raising new funds, it doesn't have the ability to continue to pay these dividends. Now, that fact is laid out very clearly in the issuing of these preferreds. There's no fraud happening here. There are no guarantees or promises being made that cannot be fulfilled. At any point, these dividends can be suspended. But some people are trying to say, hey, well, MicroStrategy has so much Bitcoin and so much profits on their Bitcoin that they never have to worry about it. They don't even have to raise new investor money. And the only way that's true is if they start to sell some of their Bitcoin. And Michael Saylor has been absolutely adamantly clear about this. They will not sell any Bitcoin ever unless they're absolutely forced to. In which case Bitcoin would have to be very, very, very low compared to where it is now. And so the situation that could happen where they are unable to raise new money from lenders or investors is much more likely than a situation in which they would ever sell their Bitcoin, which means that the likelihood they would ever sell Bitcoin in order to make debt service payments or dividend payments on their preferreds is almost zero, because a situation in which they are forced to sell Bitcoin is a situation in which they are liquidating and their company is shutting down and money is being returned to bondholders. If there's anything left over, then some of it to preferreds, and there probably wouldn't be anything left over for common shareholders after that. Now, don't hear me wrong. Personally, I am very bullish on Bitcoin. I have made a lot of money investing in and trading MicroStrategy. I am not trying to convince anybody to not invest in these things or to invest in these things. Most people simply don't understand the financials. They don't know how this money is being produced. They think, oh, this company is paying out a dividend that is just like any other dividend. And because Bitcoin's going up, they have more money to pay out in dividends. That's not true. They're not selling Bitcoin. So it doesn't matter what Bitcoin does. That's not where the money comes for these dividends. The only way they're paying these dividends and the interest payments on their debt is by raising more money. And in a situation in which they won't be able to raise more money to make those payments, they're not going to sell Bitcoin. They're just going to stop making those payments. So no, MicroStrategy and its associated preferreds are not operating a Ponzi scheme. There's no fraud going on here. But for me, the risk of owning something for a 10% dividend that has a decent chance of having its payments suspended, the risk is not worth the return, in my opinion. But now that you know how it works, feel free to make up your own mind. And if you want more insights like this, especially about things that I don't talk about on YouTube, I have a free newsletter that most of you guys don't know about. All you have to do to get access to it, click on the link in the description below, sign up, and I'll see you in your email inbox every week. As always, thanks so much for watching. Have a great day.